Your mindset towards investing is what will shape your financial success. Once you have the right mindset, you only need to set aside a regular income for purposes of your investing over a chosen period of time over which you are going to be consistent, because consistency will beat intensity in investing. Once you have adopted a commitment over your specified amounts or regular amounts you are investing, and you maintain consistency over that time that matches your goals, with that mindset, you are assured of financial success. Welcome to our today's video. I'm O'Brien Daku, and we are looking at a feedback from our own Joy Joy. Joy Joy posted, and I quote, "Hello Mwalimu, they have reduced the interest rates. Why now?" This comment or this feedback informs us that we have the right mindset, we are doing the right thing, setting aside our regular amount to invest over the given period of time, and we are matching the goals. However, there are certain pieces of information that we haven't adopted yet. And this is what we are going to be sharing through this video. We'll be looking at 7 risks associated to investing in money markets. And we shall be looking that after 3 seconds break. In the meantime, don't forget to like this video, give us a thumbs up, continue engaging in the comment section, and you can also tell us what you would want us to look at next, and also share this video to another person. If you are new to the channel, we welcome you, and don't forget to subscribe and hit the notification button, because this channel is committed to giving you at least 3 videos every week that are value packed. See you after 3 seconds break. Welcome back, and thank you for your like, your shares, and comments. Let's look at the 7 risks associated to investing in the money markets. And number 1, volatility of the market interest rates, or what we would rather call interest rate risk. One of the most important things that one has to understand, and especially because we all get attracted by the rate of return that we get from our investments. These investment vehicles by the fund managers do not dictate a particular interest rate. The interest rate that these vehicles offer us as investors, they are benchmarked on another rate. So they are dependent on the rates as posted in the market, and specific market, because we are talking about the money market, because the instruments into which the funds that have been collected by the fund managers, the amounts of money that we, the different investors, have put together and assigned to the fund manager for investing, under regulation for money market funds, the fund manager is only authorized by the regulator to invest in the money markets. As per this video that we outlined earlier on about the capital markets, the money market is a segment of the financial market that deals with buying and selling of instruments that mature in a short period of time. It has been short, has been up to 1 year, but the regulator expanded the horizon for the investments, and therefore the fund manager is allowed to invest in instruments that mature in not more than 18 months. That is 1.5 years. And therefore, the benchmarking of the money market vehicles is based mainly on the returns by the Treasury bills. And therefore, when the interest rates posted by the Treasury bills come down or go up, or rather they change, then that change is mirrored by the returns from the money markets investment vehicles. And a good example is the money market fund. Put it in the perspective that the fund manager cannot reward us with what he cannot get from the market. And therefore, the fund manager only shares what he is able to give us as per the returns that they are getting from the markets. And therefore, the interest rate to watch are the changes posted by the Treasury bills. That is the return that is used to benchmark the returns from these vehicles. And notably, in the recent time, these returns or the market interest rate as posted by the Treasury bill has been declining. We had earlier on in the year, we had the highs of 16%, 15%, and now the 91-day Treasury bill is posting a return of 12%. The 182-day Treasury bill is posting a return of 13.5, while the 364-day Treasury bill is posting a return of 3.9%. This trend is expected to continue, and we expect that in 2025, we're likely to see these returns as per the Treasury bill return going down to as low as 11%, and therefore that should be expected. The money market funds and other collective investment schemes, they benchmark their returns on the returns by the Treasury instruments. The other important thing is, as number two, will be management risk. When you invest with the fund managers, you are delegating or you are pushing your responsibility to manage your own resources to another person. And that alone is a risk. The manager or the fund manager can also make a bad decision towards the investment. And that stretches to the other side because the fund manager does not use the money. The fund manager only lends that money to another person on your behalf. It could be a bank as a fixed deposit, can also be lending to the government by purchasing the government instruments, and making all those decisions with the help of the trustee who is responsible for advising the fund manager, they can also make a bad decision. That extension to the person who has borrowed the money, the user. If the money has been invested in a commercial enterprise, a corporate bond, a commercial paper, or even a government can fail, the risk of default, if the borrower, the user of the funds, defaults in paying the fund manager, that also extends to the fund manager not paying us back as investors. And that is a risk. And therefore, that is the importance of ensuring that you always look at the fact sheets from time to time as a way of your hand establishing the extent of risk, the exposure that the fund manager has put your investment into. And if you are not able to assume the risk as portrayed by the fact sheet, then the mutual funds or the collective investment schemes, those vehicles are flexible enough and you can possibly move your investment from one fund to another fund. Number three would be what I've combined with the management risk, and that is the risk of default. And default begins from the side of the users of these funds, the users of the capital. If that person default in paying the fund manager, then that will also be reflected in our own returns and investments. And even though one of the key things that you are promised in the money market investments is that your capital is safe, is secured. The risk or these funds, collective investment schemes, are categorized, especially the money market funds, are categorized as number one, meaning they almost guarantee safety of your capital. But no, you are not guaranteed on the basis of the return, but the safety of your capital. But nonetheless, that these collective investment schemes, the vehicles, as well as the treasury, or just like the treasury securities, these products are inflation secured. And therefore, there will never be a risk on inflation. These vehicles will always give us a return that cushions our capital against loss of its value. And that's why the treasury instruments and these collective investment schemes, we categorize them as inflation secured investment vehicles. There is no inflation risk with these particular investments because at every given time, even when the interest rates are coming down, one important thing is that the inflation rate will always also be coming down because that is one of the parameters that is used to determine the market interest rates. Before the rate come down, the inflation will have come down. And that is notable from this chart. Earlier in the year, we had inflation's rate as high as 4.6, and this has gradually been coming down to the current inflation rate of about 2.7%. The fourth risk is what I would categorize as disclosure risk. There will always be the minimum amount of information that the fund manager is required to disclose to the investors as per the regulator. But to a good extent, not all information is disclosed to investors. And if the disclosure, or even if this information is to be conveyed, it may be conveyed in channels that do not reach all the investors. But it's the responsibility of you as an investor to identify the most common used channel by your fund manager for purposes of consuming the information that is being conveyed, because that is important and you are a stakeholder. The level of disclosure risk is very clear when you look at most of the comments. And that one can only be cured when you specify the channel through which you are going to be getting this information and also identifying the most used channel by your fund manager. Disclosure of information includes the mode or the amount and quality of information that you are given at the point of joining as an investor. And it's also dependent on the channel or the mode through which you receive that information. Multiplicity of costs. One thing that most retail investors do not consider is the amount of costs or the amount of expenses that they incur directly towards their investing in collective investment schemes. Notably, most of us do not consider the mobile charges that we shall incur when we are funding our account or when we are withdrawing or redeeming, liquidating our investments. We do not consider much about what the fund manager is charging, and it is notable that most of the costs that these schemes will charge, they are not known by the investor. And this is merely contributed by the fact that we don't look at the fund fact sheets when we are investing. But to categorize or as a solution, if you are going to invest in a specific fund manager, it will be better you choose a fund manager whose custodian bank is also your banker. In other words, you will hold an account with the custodian of that fund manager because the inter-account transfers do not attract any costs. You are left with only the withdrawal or the ATM withdrawal expenses if you are going to access the money from your account. Further to those expenses or costs that you are going to incur related to funding and liquidating your investment, the fund manager may have multiplicity of costs towards that investment, which, as per the regulations, some are included in the returns that you are supposed to share. The interest rate that is posted by the fund is supposed to be net of management fee and gross of the withholding tax. But above the management fee, we have entry costs, we have withdrawal costs. Some funds will allow a single withdrawal per month, and any further withdrawal in that particular month, you will attract a fee. And a good example is the AVOCAP money market fund, which allows you one free withdrawal every month, and any additional access, you'll be charged 500 shillings for that withdrawal. We have Saiton Money Market Fund that charges a ledger fee of 50 shillings on a monthly basis. Other costs that may be attracted, those are performance costs that relate to performance of the fund, but majority of the funds that we have been looking at do not charge that particular cost. Risk number 6 is exposure risk. And as per the regulations by Capital Markets Authority, the fund manager is required to spread the portfolio or invest the amount in that fund into at least 4 asset classes. Or in other words, divide that fund into 4 and invest each part into a different class of assets. That is purposely for the control on diversification. When you look at most of the fact sheets, we have funds that are spread into 3 classes, others are spread into 1 class, and others potentially put over 90% of the fund into 1 asset class. But for purposes of that regulation is to minimize the risk exposure in terms of distribution of the fund into at most 25% of the fund. And lastly is the horizon risk. These funds are limited to an 18-month horizon, and owing to the fact of the correlation between the horizon and the return, the longer the duration of investment, the higher the expected return, and therefore for this short-term horizon, we expect lower returns, and therefore these funds are bound to give us lower returns compared to other investment options. Thank you for watching.